Well, good morning and good afternoon, depending on what coast you're on. I am Carrie Scott. I work at Spruce Health. I'm joined by Nate Goodman today. I'm so excited to have him here, and I'll intro him in a second. I'm watching those numbers climb. We're getting a really good group going. So for the sake of not wasting time, I think we're just going to jump right in. Just to remind everybody, well, there you go. We are here today to talk about the 7 core strategies that are going to save you money on your taxes. And this is just a quick look at the agenda. I'm going to introduce you to Nate, a quick slide on what Spruce is for those of you who might be new to us. And then we're going to get right into those strategies. And Nate is an expert, so I'm excited to hear what he's going to talk about. Before we get into that, though, real quick housekeeping. We've disabled the chat function. It just kind of keeps things cleaner. So when you have questions, just drop them into the Q&A. And if the questions are relevant to the material that Nate is covering in that moment on that slide, we'll take them. Otherwise, we're going to save them until the end and dedicate about 15 minutes to getting those answered. The session is being recorded, so if you miss something or you have to drop off early, do not worry. I'll be sending that link out after we wrap. I think that's everything I wanted to cover. But I do encourage you to ask questions because we have Nate here live and we can get those answered. So please drop them in there as you think of them. And with that, let's get into the intro. So we know we're tackling the topic of taxes today. That's a tongue teaser. And let's meet Nate. Let's just get into it. So I'll give you the quick intro and I'll let Nate speak for himself since he's probably better at that. But Nate is joining us from Goodman CPA, which he founded in 2019. And I love that his mission was to prioritize people and put them in the best tax position possible. Nate, I'm going to let you talk about yourself because you know yourself best.
Sure. Yeah, I got into accounting in a non-traditional way. I went to undergrad to be a pastor. And that's where I think my prioritization of people, long story short, I met an accountant and fell in love with it and had this whole goal of hopefully helping people with their tax situation and accounting situation, because it just seems to be a really big headache for a lot of people. And so we try to take an educational approach to the people we work with. And because of that, we've been able to help save people a significant amount of money in taxes. We generate probably around $8,000 to $115,000 for our clients every single year, ultimately relying on the advisory base of our work to be able to work alongside clients, personalize whatever they need. People that are in the healthcare space, ultimately, there's a lot of moving pieces, and so the personalization's really needed to be able to deliver those tax savings and healthy and good advice. And we ultimately want to see those in our healthcare industry succeed and thrive, because you all are at the forefront of a lot of people's headaches, our general public. So however we can do that, we're here to help and ultimately help put people over our profit.
I love that. An altruistic CPA. How often do we come across one of those? My goodness, Nate, I love it. Perfect. All right. Well, what's Spruce? I think the bulk of you joining today know what Spruce is, but if we have some folks who aren't as familiar, Spruce is a healthcare communication platform, and it's designed for all of you on this call, and it makes HIPAA compliance pretty easy. It does consolidate all the communication channels. So from phone to fax to text and telemedicine, it's in one unified cloud-based solution. And people often like to say it's like having their office in their pocket. You can take Spruce on the go, and it makes running your practice so much easier. So that's the nutshell version. But if you have more questions on Spruce, by all means, drop them in the Q&A. And with that, are we getting into the meat of it? Let's see. What's our next slide? I think we're into the good stuff. Yes.
We're into the meat.
So
Yes.
I'm going to turn off my video and let Nate run with this, but I'll be back and I'll be working in the background with questions that come in.
And I'll give you a quick plug, Carrie, because I use Spruce as a patient with my doctor, and we also see it on the CFO side when a clinic or a private practice has an efficient back end
Yeah.
Patient satisfaction is up, the patient interaction is better. So however you can streamline those processes is awesome. And so from my perspective, it's been really
I
nice.
I love it. Well, thank you for that, and we didn't even pay you to say that. Thank you,
Yeah,
Nate.
you did
I
not.
lo I love it. All right, good. Well, I'm gonna let you take it away.
Awesome. I appreciate it. All
Okay.
right, so let's dive in. We as a company focus on how many strategies can we find to be able to reduce your tax liability and put you in the best tax position possible. So as we work through these strategies, I'll try to give you as much detail as I can on what it takes to put this into place, why we do these. But ultimately, you as a business owner, it's okay if you don't do a specific strategy because you never want to let the tax tail wag the dog. Um, Meaning, it's better to make more money than to pay less in taxes. I say that as a premise as we dive in. So kind of an intro to these 7 strategies. We've used these strategies and more to help our clients save anywhere from 10 to 100,000 plus annually. Since starting the firm, we've been able to find our clients so far $5.8 million in tax savings by implementing and putting into place these proven strategies. And combined with proactive tax planning, these strategies have really been able to build a strong financial foundation for healthcare practices, private practices, to allow you to have long-term growth. We want to take the tax dollars that you're paying, and if you can pay less of those, we can put those back into your practice. You can invest them into your patients, invest it into your family, into your community. So we'll dive deeper into each of these strategies and give you some detailed guidance and hopefully some actionable advice to enhance tax planning and savings. So the first one that is a lot of people take advantage of, but then we also see a lot of people that don't take full advantage of it is the home office deduction. Another similar strategy that we use to this is called an accountable plan. If you are not elected to be an S corporation or a C corporation, you can take advantage of this home office deduction. What it allows you to do is to claim a portion of your home expenses, such as rent, utilities, maintenance, lawn care, pest control. They're unrelated to the specific the home office you have, but they are used in total for the home. So we can claim all of those expenses and take the percentage of your home to calculate how much you could actually deduct. So there's a simplified method, and we have a lot of tax preparers that default to this because the other method takes a lot of legwork to put into place, but we could be missing out on substantial savings there. So the simplified method, let's say you have a 2,000 square foot home and you have a 300 square foot home office, then you can deduct $5 per square foot of your home used for business. It's a super simple method. Just make sure that you have an area that is exclusively and regularly used for your business. There has been court cases and such where people were trying to fight because they were trying to claim a bathroom. And while the IRS agent was there, one of their kids ran in and used the bathroom, and the kid's not an employee of the business. So they overturned being able to use like the bathroom as a part of that square footage calculation. We see a lot of our clients, they'll miss out on like storage space. So if you're storing medical supplies, office supplies in a closet or a certain place in your home, you should add that to your square footage calculation alongside of your desk space. If you're an S corporation, a C corporation, or a partnership, you can't use the home office deduction directly in your business. You'd have to set up an accountable plan. An accountable plan is either a written document or a verbalized document where you say, if you spend money for the business, then, but you pay for it personally, the business will reimburse you. You can create an accountable plan that is exclusive for shareholders only. So if you have a lot of employees, you could still get the home office deduction. Another really cool way to use this deduction is if you do have remote employees, like if you have a remote receptionist or a remote scheduler that's a full-time employee or part-time employee with you, instead of paying them a full salary, you could take a portion of that salary and say, hey, I'll actually reimburse you for your home office. What that's going to do is it's going to help you pay less in FICA taxes as the employer, and the employee is going to not pay FICA taxes on that reimbursement. And they're also not going to have to pay income taxes. So it's a win-win for employers and employees to offer this. Another place we get hung up on the home office deduction or the accountable plan is if you go to an office regularly. So you can still claim a home office deduction even if you have a workplace, if that workplace, you can't do certain work there. So certain people can't review their financial statements at the office because they're in a more public workspace. Certain people can't have manager level meetings, so they have them at their home office. When you start having exclusive activities that you can't perform at that workspace, you can pay rent for that workspace and still claim a home office deduction. So we found a lot of ways to be able to still take advantage of this strategy without without the compliance hassle. And then a big thing here is keep track of your home expenses. So use an app like Rocket Money, Credit Karma to track all your home expenses. Or if you're really savvy and you like to do it the accountant's way, you could keep a paper ledger of I paid my electric bill this month and I paid my telephone bill this month. But we usually say, if you want to have less documentation, there's plenty of apps out there to help you keep track of all your home office expenses. And that's where the second calculation method comes in. This is the regular method. This is our preferred method because it gets the most deductions. You calculate actual expenses used to upkeep your home. And then if you have any direct expenses, like you buy a desk or a chair, maybe you get a fancy standing desk for your home office, all of that you could write off 100%, opposed to getting caught up in the percentage of the home issue. So ultimately, what you need to do to make this in terms of documentation, you should keep a detailed record of your expenses and a floor plan showing the business. So you could just take and draw out your house's floor plan and mark out where the home office is. And sometimes you can go to your public county's like tax office to get a layout of your home, and you could use that as substantiation for what is your home office. So if the IRS does ever come knocking, you've got all the documentation in place to show them, hey, look, we've got all of our ducks in a row here. We're not trying to be shifty. We're just trying to take advantage of the deduction that's rightfully ours. So that's the home office deduction. If there's any questions, feel free to stop me there, but we'll move on to the next one.
Nate, we did get a couple, which I'll throw your way now if that's okay.
Yeah.
Okay, great. So a couple folks just wanted to make sure that you did say that if you're a C or S corp, you cannot take that deduction, correct?
Yeah, that's right. Not the home office deduction specifically.
But
However,
the accountable,
you would set up an accountable plan, and then we would run through these same requirements as the home office deduction. But we call that strategy an accountable plan because we put a written document in place that all the shareholders sign, explaining that we will reimburse shareholders for their home office. Just another layer of substantiation than just trying to directly write off the home office through the business, if it's an S, a C, or a partnership.
Okay, great. And for the simplified method, is this what you deduct once a year or monthly?
Yeah, for the simplified method, from an accounting standpoint, you would just do it once a year, like in your QuickBooks. You could put it in there at the end of the year to show like this is what I used for the year.
Okay, perfect. And then this person would like to know, what if you work part of the week in the office and part of the week at home?
Yeah, so that goes back to if you can define a purpose for why you are working from home opposed to from the office. If there's a justification for needing to use that home office, then you could still take the home office deduction even though you're at both places. I think you could easily say that if you had a hybrid schedule or if other employees were doing it as well, would be an easy way to justify that expense.
Okay. All right, good. This may be a bigger one and you may want to get into it later. I don't know, but Kristen's asking, how do you set up the accountable plan?
Yeah, so there's a couple ways that we set up an accountable plan. There's websites you can use like eForms to look up like a template. You could use like a chat GPT to create a template. Our team, if you work with us, our team helps craft the plan and we just have you sign the plan so we can formalize it. But you could use sites like that to develop an accountable plan. And if you Google search it as well, you'll come up with a lot of different templates that you could use.
Okay, brilliant. We've got a lot of interest on this topic. I hope it's okay to answer a couple more.
Yeah, no problem.
Carrie is saying, if you have two homes, like a summer and a winter home, can you take two home office deductions, one for each home?
Potentially, it might get more exclusive. Like if you're going to use both of them, the biggest thing here is the regularly criteria, regularly and exclusively. If it's a vacation home part of the year, so you're renting it out and then not, it's going to be hard to get the regularly used for business criteria crossed. But if it's like just closed in the winter and then you go to your cabin, in the summer and nobody else uses it and it's regularly, we'll probably take a deduction for like half the year and then combine the two homes. But that one's a little bit more specific, and I'd probably have to look at your situation and ask a few more questions back to you on that one.
Okay. Okay. Good answer though. Marquita would like to know, can I claim my home internet if I work from home from time to time, even if I don't have a home office due to limited space?
Yeah, that's where it gets more tricky because you would have to at least mark out somewhere in your limited space. It doesn't have to be a whole room. I think that's also a misconception. Like it could be in your kitchen area or, breakfast nook, but tucked to the side, or if it's in the living room, but it's the corner of the living room and no one else touches it. You like, this is exclusive. You can even put tape down. Don't come in my home office.
Yeah. Yeah.
Then you could get the percentage of your internet bill for that part of the apartment, condo, townhouse home.
Goodness, that sounds like a lot of work, but hey.
Hey, you could make it work. It depends on how hard you want to work to get your deductions.
Yeah, exactly. Exactly. Tabitha is saying, so she's an LLC, but she files as an S corp. It sounds like she needs to go with the accountable plan. Yeah.
That'd be right. Yep.
Okay. All right. Good. I'm just going to do one or two more and then we're going to let you keep going. So Joseph is saying, what about constructing a home office as a home addition? Is it 100% deductible or just the percentage of the home X the cost?
Yeah, I can get into the weeds a little bit with you on that. It's going to go into the total home value, which is your primary residence. So when you sell it, you're going to benefit personally. So you wouldn't write it off directly like you're talking about, but you could depreciate the cost over time as a reimbursement. So whatever it costs to build the additional home office, we could then, when you submit your reimbursement request to the company, you would put in there, here's all my electric bills, the percentage of the home, and then depreciation I want to be reimbursed for. There is a catch when you start getting a reimbursement for depreciation. Whenever you go to sell your home, the IRS is going to have depreciation recapture, and they're going to require you to pay additional taxes above the exclusion, which we'll talk about the primary home exclusion here in a little bit. So you could do it. It's not a direct write-off, but it'd be through depreciation to get that.
Oh my goodness, you have all the answers. Okay, I have one last question and then we'll keep going. Robert is saying, can a nomad physician get the home office deduction?
If you're a nomad and you're living, in a van, or I had a buddy who did, locums, and he was living out of a van he built out. Pretty hard to find any home office space in there, or any that's even like really worth the the compliance work to put it into place.
Yeah.
So probably not, unless you are, going to like some Airbnbs or something like that where you're doing like midterm rentals. You could potentially get it then.
All right. Brilliant. Okay, I'm going to let you keep going, but we'll circle back later on when we have our time at the end.
Awesome. We'll move on. So I have 3 kids. These are my 3 little kiddos. We like to hire family members if you can, because there's a lot of tax benefits to hiring your kids, and there's a lot of different things that they could do. The one kind of threshold we have to clear is typically the age of the kid. So if they are under the age of 7, they can't do any substantive work that the IRS sees that they would be reasonably able to be paid for, except for one thing. They could be a baby model. So if you want to take a bunch of pictures and post them on social media, maybe put a huge billboard up on the interstate or something, we could pay the kids that are under the age of 7. But again, it has to be a big thing here. Is it has to be reasonable. You're not going to pay your kid as a baby model $20,000 for one photo shoot. You're probably going to pay them $150 to $200 an hour, depending on how much time they put in. So if you want to pay them a lot of money, you would have to do a lot of photo shoots, and it would have to be used in advertising, right? We're not just going out and taking family portraits. So that's one caveat we get through. So if we have kids over the age of 7, we start getting into a range where kids can do work in the office to help you out. So they could shred paper, they could come and empty the trash, sweep the floors. Once they start getting a little older, maybe they can help answer the phone and schedule appointments, or if somebody needs something, they can be the kind of intermediary person, and they start moving out of the cleaner organizational work into more of a administrative role. And something that is a very high paying job now is social media managers. And I'm assuming most of you all have social media pages of some sort. It'd be good to have those active. And so just explaining how you help people and take care of people. They can help take pictures, manage posts, do comments, interactions. And a lot of kids now are really savvy with technology. And so this can be a great way to get them paid. We say the biggest tax benefit comes for the children that are under the age of 18, above the age of 7, and they're working in a family business. A family business is not an S corporation or a C corporation or a partnership. It is a Schedule C. There's still benefits to hiring your kids within the SC or partnership. But the biggest benefit comes when you hire them within a Schedule C company. The reason why is if you hire children, your children under the age of 18, they're exempt from Social Security, Medicare, and unemployment taxes. Also, the standard deduction is around $13,000. It just goes up every year. So you could pay your kid $13,000 for taking cash out of the business, putting it into a bank account that you set up for them. If cash is an issue and you're like, we need it to pay for the family bills, then you could just have the kid pay you rent or pay you a stipend for the groceries. But you have now taken that $13,000 out of the business, totally tax-free, and you'll never pay any tax on that because the child won't pay it because they are right up to the standard deduction. That $13,000 is going to get eliminated and there'll be no income taxes. You have a lot of kids, there's a lot of potential deduction there. And then the next kind of superpower that partners with hiring family is you could then take that money and put it into a Roth IRA. And now you are generating tax-free growth for your kids every single year. I think I ran a calculation once. If you did this every year from the age 7 to the age 18 and did the max Roth contribution, your kids would have like over $1 million in tax-free income by the time they retired. So this is a really cool deduction that you could take advantage of. So what are some of the benefits and requirements? So obviously salaries paid to your family members are going to be deductible as business expenses. So we're taking it out of your income and we're shifting that income to potentially lower tax brackets. There needs to be valuable work experience. So they have to provide practical skills. It also helps your kids learn work ethic. So we love to be able to teach our kids, good values. And then compliance. The compliance piece here is you need to ensure the work is performed. So keeping a hour log, tracking their time. You have to pay them a reasonable wage. So you could use like Indeed or salary.com or one of those to check what somebody who could be paid that's a janitor in your area, or somebody that could be paid that's like a secretary or receptionist or a social media manager, and use that information to kind of document how you're justifying what you're going to pay them. We don't want to pay them unreasonably. There's plenty of court cases where people win, And then there's plenty of court cases where people lose because they pay their kids an absorbent amount of wages and they've done no work, or they haven't documented any of the work. Um, so that is the hiring kids strategy. We do this very frequently with our folks. We help set up their payroll account. We make sure that everything is compliant and in place. We help build the job description and the job hours log, all of that work, so that it takes it off of you and allows you to still get the deduction without any of the extra headache. So, any questions on hiring family?
Yes, this is incredible. Very cool topic. Okay. Let's see here. So starting up at the top, Holly's asking, can you pay the baby model for each time you post one of their photos, or only the time spent on the photo session?
Yeah, that's a good question. We typically only do for the work completed. Uh, we could take some time to like substantiate some sort of agreement of like, hey, if we use this, we'll pay you per use or for like a package. But again, it has to go back to what's comparable to that industry. So when people pay for baby models, they're typically paying for time, and the babies are not receiving royalties for the use of their image. They're just paying for, hey, we need you for X amount of hours. And so we would have to do what's comparable to if you weren't the business owner trying to get a tax deduction and you needed a baby model, what would you pay?
Right. Okay, good. Adam is asking, what are the options for hiring your kids if you work in a partnership?
Yeah, so under the partnership structure, um, you could have an agreement with your partners that because partnerships can be structured very in various ways. So you could say, hey, I'm going to pay my kids through this. I want to reduce what I get as a partner's draw. Would be one way to do it. That's probably the most simple way to do it. You will have to pay FICA taxes, Social Security, Medicare taxes on the kids. So you'll lose out on that benefit, but you'll still get the income tax benefit. The only other issue there is your other partners are also going to benefit in the tax deduction in most situations. The other way you could structure it, and this would be a much deeper conversation, we do entity optimization with partnerships. So we would take your partnership structure and then we would have the partners of that partnership be individual companies. Then you could run all your tax strategies through that company that you own that is a partner in your partnership. There's other legal ramifications that I don't advise on. We'd have to work with an attorney to decide, under the medical board requirements, what's there, and just figure out all the requirements to make sure it would work. That's how we typically get family members employed without giving the benefits to the other partners and also trying to be equitable among all the other partners.
All right, good stuff. Kim is asking, do you have to have proof of paying kids, like a monthly check written out to them? Do they need to have an invoice for proof of what they're doing, etc.?
Yeah, documentation is going to be your best friend here. So you would need a pay stub. You should actually write a check. It doesn't have to be monthly. It could be once a year. And you want to have a job description and a log of hours worked. So we can see physical money moving, not just a paper trail. We also need the money to move as well.
Okay. All right. That makes sense to me. Do my kids have to be registered to my company to be qualified?
They would have to be on payroll to qualify. So if by registered, you mean that they would be on your payroll system, if it's ADP, QuickBooks, Gusto, one of those folks, they would be a part of that payroll process, yes.
Okay. Can a sole proprietor hire their kids?
Yes.
Okay. Gosh, there are just so many of these. And for the sake of time, I'm going to let you keep going.
Okay.
Again, we'll circle back. And then also, you guys don't fret. There is information at the end of this for getting in touch with Nate. And you can always book a consultation with him. So we'll let you keep going, Nate.
Yes, we do free strategy sessions with our client relationship manager. So if you're like, hey, I want to learn more, I want to ask questions, by all means, feel free to reach out to us. We'd love to have a conversation to get to know you more.
Amazing.
All right, so next one, this may be apply to some, but not to all. If you have employees, you can take advantage of an Employee Achievement Award program. These are non-cash awards, and they're not cash equivalents. Cash equivalents are like gift cards, checks, some sort of money order, you name it, that's a cash equivalent. This is like a turkey, flowers, a computer that's under $400. You can give your employees an achievement award up to 4 times a year. Each award cannot be more than $400. And what happens is when you give this award, you don't have to record it on payroll. So there's no FICA taxes, there's no income taxes, and there's no employer FICA taxes as well. So this is great if you want to boost morale, retention. You could have a quarterly like achievement award plan where you go in and say, hey, we're gonna, instead of like a big cash bonus, a lot of people want something else instead, or they're going to use their bonus on something else instead. Hey, so why don't we buy you that tablet, or why don't we buy you that computer, or different things that they might need or want? And then you could basically allow them to, you get a deduction for giving the award, whatever you pay for, and then the employee doesn't have to pay income taxes on that. Cash bonuses are taxable, but this allows us to structure them to be able to maximize the benefits. Optimizing awards, we can do this to use it as a performance-based criteria to qualify for tax deductions. Also helps consider like the longevity of awards for long-term employees to enhance retention. That's where we kind of get into the CFO conversation of, if employee retention is a problem, we can leverage these types of plans at a fairly reasonable cost to be able to maintain your employees. You do have to maintain documentation, so there has to be a written awards program, what the criteria is to get awarded, and what the recipients and who the recipients can be. Questions on that one?
I'm sorry, I was just talking to myself. Here we go. Okay, I was just about to type an answer, but then I thought, well, let's check with you first. Cheryl is asking, can an achievement award apply to one employee?
Yes.
Okay. All right. Good. That makes sense. The achievement award is for W-2 and 1099?
It would be for W-2 employees.
Okay. W-2. All right. Can you do the award system? Oh, well, now this is probably the same thing. For a contracted employee, not an employee. Okay, so it has to be W-2.
Yep.
We just answered that question in real time. Okay. And Laura's saying, what if you have just one employee? Yes, you can give them that award. Doesn't matter.
That's right.
1 or 10 or 100.
The only person that can't qualify is if you're an S corporation owner or a C corp. So if you're the owner, you can't say, "Oh, I'm going to give myself an award for all the good work I've done." You definitely deserve it, but you can't get the deduction under this plan.
Okay. Okay. Perfect. Good. All right. We'll let you keep going.
Awesome. So this is where we talked about the accountable plan previously. We also use the accountable plan for other types of deductions, and that's the reimbursement for OOP, or out-of-pocket expenses. So some tax benefits here. You're going to get to reimburse your employees for business expenses without subjecting these payments to payroll taxes. We see often people just fail to comply with the accountable plan requirements. And so they're at a risk of an audit, or a risk of, if they got audited, this would be a point that would be a potential risk. We need employees to give us a receipt, to follow some sort of written plan, an agreement, or a verbal plan. Say like, we won't pay you back for business expenses if you spent more than $2,500. You need to make sure that you establish the clear guidelines for reimbursable expenses. So if your employees are going out and buying office supplies on their personal credit card, do they need to fill out a form? Do they need to get approval first? Do they need to submit a receipt? Then you want to use some sort of standard forms for expense reporting. They can explain what it is, leave a little memo. There's companies that help you do the reimbursement policies well. Some payroll processors I know will do reimbursements now, as well as like Ramp and Expensify, some of those other softwares help you manage the compliance piece of expense reporting and reimbursements. And then we'd have to constantly monitor compliance to ensure the IRS standards are met. So that's where making sure that your employees are following your guidelines, as well as those guidelines adhere to what the IRS requires. The requirements here is there must be a business connection. And just go out and buy a bunch of random stuff and you reimburse them for it. And you can't go out and buy a bunch of random stuff that doesn't apply to the business and get reimbursed for it. Substantiation, you as the owner, you're also an employee. If you're an S corporation or a C corporation, you would have to substantiate that expense with a receipt, and then you must return any excess amounts. So if an employee got a extra reimbursement and then the vendor said, hey, it's like Walmart, they refunded them for whatever reason, they would need to make sure they gave that money back to the employer. So that is a reimbursement for out-of-pocket expenses. We can also do mileage deductions through there. The accountable plan, again, you can use for employees' home offices and do a home office reimbursement for your employees. And so there's a couple other ways we use that reimbursement for out-of-pocket expenses via the accountable plan.
Okay, awesome. I have one question from Alex. How do you reimburse yourself for startup costs that you used personal funds for if you're the only employee?
So if you documented all of them, depending on the amount, you could pull together all of your receipts and have, if you had enough money in the business bank account, if not, you could deposit money into the business bank account and then have that business reimburse you for those expenses, and then keep those receipts, in I like to store everything digitally. If you use QuickBooks or Xero or one of those, you usually can attach transaction receipts to transactions. So you could do that there. You keep it in a online document storage place, you could keep it there. Or if you use an old file folder system, you can keep all your receipts and like your calculation there, so you have documentation for it.
Perfect. Thank you.
Of course. All right. So if we have any of you in the medical space that also like to get into real estate, we do have quite a few people in real estate as well that we've been able to work alongside of. A lot of people will move a location, like you'll move across the country or you'll move to another state, and you have rental property where you live and you want to kind of liquidate everything and move it to the new location. Instead of just going out and selling that without thinking about the tax implication, you could do a 1031 exchange. And there's a lot of information on the internet and a lot of information and compliance that would need to happen to do these, but it can have substantial tax savings. The big benefit here, you get to defer capital gains on the sale of investment property by reinvesting that into a similar property. You can preserve capital for reinvestment rather than paying it immediately in taxes. To be eligible, both properties must be held for productive use in a trade or business or for investment, and then the exchange has to be completed within a 180-day window. There are some types of trusts that you can actually defer your 1031 exchange into them and then get it to go over that 180-day requirement. But typically it's a 180-day waiting period. Some types of exchanges that we've seen happen, you've got simultaneous exchange, so direct swap. Hey, I like your house and you like mine. How about we just swap the deeds? You have delayed exchanges. So you sell first and then you wait and then you buy 180 days. Or you have a reverse exchange. You buy first and then you sell the old property. We typically use an intermediary to help with the compliance work to make sure that all the I's are dotted and T's are crossed. But again, here the benefit, it increases your buying power, helps you grow your real estate portfolio. And it's, if you're rolling it already into another investment property, it's, kind of like, why are you paying the taxes now? Why wouldn't we defer and hold the cash longer? Any questions on that one?
We are good on that one.
Okay. That one gets in the weeds a little bit.
Well, yes, we did have someone say that they absolutely want to talk to you about it. And I said, don't worry, I will be providing you his info. So there is interest.
Perfect. So now we're talking a little bit about real estate. A big point of confusion is this home gain exclusion. If you are, your primary residence, so I live in a little ranch brick house, My wife and I live there. I can sell that house tomorrow. If I bought it, just use some land examples here. If I bought it for $100,000 and I go and sell it for $600,000, I will pay no taxes because it is my primary residence and I'm going to go buy another primary residence. Um, Big tax savings here, significant tax savings without the need for reinvestment of proceeds in another property. You get the flexible and beneficial for those planning to downsize or relocate. Some documentation, make sure you just maintain your records of ownership, maintain records of like if you're doing improvements on your house, keep track of how much money you're putting into your house after you bought it, because all of that adds up. So if I bought it for 100,000 and then I put $400,000 into it because I wanted to build a 10-car garage and 6 stories, I don't think you could do that for that little money. But if you did that and I sold it, but I didn't keep track of any of that, and they wanted to ask about that transaction, I would have a hard time backing it up. So other eligibility requirements, you have to live in the home at least 2 out of the past 5 years. There are some exclusions to that rule that we've worked through with people before. So happy to talk through the exclusionary criteria. And then the use, you must have lived in the home as your primary residence for at least 2 out of 5 years. So ownership and use. So you own the house for 2 out of 5 years and you lived in the house for 2 out of 5 years. Some people will do this when they want to sell rental property. They'll go live in it for 2 years and then sell it. So that's another way to use the home gain exclusion to your advantage.
Okay, good stuff. So nothing specific to this, but a bunch of questions for the end.
Okay, we've got one last strategy here, and then we'll switch to those questions.
Amazing.
So I don't know if we have any golfers in the audience, but if you like golfing, this strategy is named after Augusta, Georgia. It's called the Augusta strategy. Tax-free income. So this is the benefit of the strategy. You get tax-free income. You can rent your personal residence to your business for up to 14 days per year without declaring rental income. So what happened? There were some Congress people that decided they did not want to pay taxes when people came to the masters. So they said in the code, rental income or a property is considered a rental property when it is rented out for 15 days or more. So anything that is 14 days or less is not considered a taxable rental, and there's nowhere that you have to pick up that income. So what you could do is you could have a staff party at your house. You could have corporate retreats at your house or corporate meetings at your house. We have our clients that will meet with us. We'll have our meeting virtually. They'll be at their house, and we'll count that as a corporate meeting. You can then, if you rent this house, your personal house out to your business, you can determine a fair rental rate. So if you look at places like Pure Space or Liquid Space, they can help you determine a rate for your home. You can then have your business pay your personal self or your family for renting your personal house. You get a deduction at the business level, but no taxable income at the personal level. So we are moving cash from the business to you personally, tax-free. We always say we try to take cash. We're trying to take cash from the business and put it in your pocket without any tax implications. So the benefits, you get to utilize your personal assets to generate tax-free income. We get to deduct a business expense. It really is a win-win situation for personal and business finances. Rental payments, there must be real money moving. It can't just be like, well, you owed me, so the business, it's fine. We'll count it as an expense. And then you have to do some implementation steps. So we need to ensure there's a rental agreement in place, that the rental rate is fair market value. You have to use the home for a legitimate business purpose. It can't just be, a pool party or something, unless your team is coming over to be a pool party. And then the compliance, just make sure we're adhering to the IRS guidelines, because the Augusta rule, unless you don't have your documentation in place, it can cause you a lot of headaches if you were to get an audit. So we want to make sure all the documentation is in place, so you don't, if you got audited, you're not at a risk. Some people ask, is this create a bigger audit risk for me? The deduction is listed as a rental expense on your business. It's not like some strange thing we're doing. It's just an additional deduction to the business. So in our mind, there's not like some big red flag we're throwing up saying, yes, I'm going to get audited more because I've taken advantage of the Augusta rule. Again, we're not trying to be shady. We're trying to take advantage of the deductions that are there and that are written inside the revenue code. So that's the Augusta rule. We use this primarily with all of our clients because it's a great strategy to put in place. There's a lot of benefits.
That's awesome.
Questions?
Yeah, thanks, Nate. So we have a question from Emily. Does it have to be your primary home?
If it's not a primary home, it just can't be rented for other purposes. So, like if most of our clients that have multiple homes, a lot of the times that other home is being like a vacation rental part of the year. But if it's not, you could potentially have multiple homes that you can use. Another big piece there, we don't typically take it for people who are single member LLCs that are disregarded. So that means you have not elected any sort of status with the IRS. We use it for folks that have an S corporation, a C corporation, or a partnership, because there's a very clear line between business and personal when you do that. There's two different tax returns, and the books and all are kept separate.
Okay, let me make sure I got that right. Because Shauna asked, how does Augusta strategy work for solo/LLC? Just pay from work account to personal. And you're saying it's just for SC and partnership?
That's right. Yeah, that's our position on it, because we like to have as much separation there when we make those payments. So if you're a single member LLC, you could elect to become an S corporation. You're still an LLC at the state level, but you're telling the IRS and your state tax agency, so from a tax perspective, you're now an S corporation in their eyes.
Okay. All right, good. Let's see here. Let's see. How does the payment need to be recorded in order to use this rule, i.e. which chart of account? Chart of account?
Chart of account. Yeah, it'd be your if you have like a rental expense line or rent expense, lease payment, or something in there, one of those expense lines would be what I would use.
Okay. Okay. A meeting or event is generally a few hours. Does one event count as a full day?
So you can use, if you look at some of the websites to do the substantiation, there's an hourly rate that you could charge if you have longer meetings. The other thing here for substantiation, you'd want to have meeting minutes written and documented. And if you have photos, that goes another long way to kind of write down the meeting minutes, add the photo to it. So you can be like, this is a real meeting that happened. But yes, longer the meeting, if you do an hourly rate for substantiation, would be a larger deduction.
Okay. All right. And it sounded like in your example with your business, that sometimes you use this strategy for virtual events. So does the Augusta strategy apply to virtual business events?
Yeah, so if you're using your home to host the event, even though it's virtual, you're still in your home using it for that purpose. As long as there's a clear line between, like if you have a home office and you do virtual meetings, and then for some reason there's another event that you're doing that's very distinct and separate, would be an easy way to differentiate that. But
Okay.
for sure, you could use it that way.
Okay. Cheryl is saying, using my home, can I use this strategy to host an event for others in the same profession, but they're not employees? Like, could this person host a self-care retreat?
Yeah, yeah. So we typically say you have to do things that are deductible are ordinary and necessary. So it doesn't have to be your employees. If you're doing an industry event or having customers to your house or other fellow people to your house that are in that industry and it's related to your business, and people in your space specifically are able to do that a little bit easier because you have those kind of self-care retreats and those types of things that you can do, opposed to maybe a plumber might not have people over for a plumbing party.
Right, right. Well, and I was just gonna say, so Emily sounds like my kind of gal. She says, what if you're
Yes.
an S corp but a single owner? Can you throw parties for yourself?
So if it's just you and you don't have a spouse, um, it's harder to do that. If we have spouses, the spouse can usually be a consultant and have conversations about the business together. So if you're like meeting on a Saturday and talking about all these business logistic items and it's like a set aside time, um, you could get it. But if it's just you, again, I like that idea that somebody threw out there of having, other people in your industry. It'd be a great way to get to know people and inviting them over and saying, hey, we're gonna have a party at my house. We're gonna talk about all the problems within our specific, industry.
Mm-hmm, mm-hmm. Okay, Holly's following up and saying, does the spouse have to be an employee of the business?
The spouse does not have to be an employee of the business.
Okay. Patrick says, you mentioned spouse, but are DPs included? I might be out of it, but what is a DP? Do you know,
Uh,
Nate?
I don't know.
I'm thinking maybe that
Oh,
is like
the
a domestic partnership.
domestic partnership, that might be right.
Yeah,
Yeah. Yeah, if it depends on your state, but if like your state has a domestic partnership, that might be all states now. You can you could count them as well if it's like considered a marriage because of the time spent together.
yeah. Okay. All right,
We'd have to
good.
look into that. It might be a case by case thing.
Yeah, yeah. Well, and then earlier, someone asked about the hiring, your kids, and they said, well, what if it's stepkids? Which I thought, well, maybe, but then it was an unmarried situation, which then gets really murky. And I thought, no, probably not.
Yeah, that's where there has to be, if it's stepkids and there's not a marriage, that would they would pay FICA taxes in that situation, so the Social Security and Medicare, but you still would get the income tax benefit. So that, like, if you're an S corporation, you're going to pay the Social Security and Medicare anyways, unless you have a family office management company. So the benefit's still there from an income tax perspective, even if you don't aren't avoiding the Social Security and Medicare taxes.
Got it. Okay, perfect. All right, let's now kind of start back up at the top and answer some of those earlier questions.
Yeah.
We've got about 7 minutes left, and I want to leave a minute at the end to show Nate's contact info. So someone said, I sold my medical practice last month. What suggestions do you have regarding taxes on the purchase income?
So you sold your practice last month. We're probably on the too far on the tail end of the transaction um, to like defer some sort of gains on it. If you're planning to continue working, if you take that money and reinvest it in your next business, a lot of the times those businesses put off a lot of initial costs that we could write off to offset the income that you're generating from the sale. Um, you can purchase you could purchase a short-term rental and do a cost segregation. That would be a huge benefit if you do a cost segregation on a short-term rental. uh, I'll speak high level here, but you don't get caught up in all the passive activity loss rules, meaning you can't deduct the benefit of buying that property or that depreciation. Short-term rentals allow you to do that under certain circumstances. There's a lot of additional check boxes to check off to do that, but you could potentially offset all the sale of the business income by putting it into a short-term rental. Again, there's some other requirements in there that I won't get really in the weeds with, but that would be two ideas I think I would have.
Okay. All right. Good stuff. All right. We have a couple of questions going back to that home office deduction, and these folks are getting creative. So the first person said, half of my guest room is used as my office and use parts of my garage, my car as storage. I estimate the square footage of the entire guest room. Is that acceptable? I don't, that sounds a little confusing.
I would measure it. I would just measure all the spaces that you're using. I wouldn't just take the guest room, because if you do have guests come, unless you just have a bed in your guest room to take a nap, and you don't actually have the guests stay there, I would measure it out if you want to be 100% compliant and safe.
Okay. All right. This is another one. Mary's saying, I'm a sole proprietor. I have a storage space at Public Storage. Can I include any of that in my taxes, like the monthly payment, the square footage, any of that?
I mean, if you're using it to store business, all your business stuff, for sure. If you're using it a portion, like storing part of your stuff in there, then maybe we could get a portion of it.
Okay. All right, good. Let's see here. All right, we have just so many that I'm just looking for some good nuggets here. We are doing an addition as an ADU specifically for the S Corp. Corp would rent the space, and we have no other office location.
That's fine. Yeah, as long as it's used for business purposes. Yeah, you can. We like. I don't do this, but I built a garage in my backyard. If I were to store all of my clients' work papers there, and I were had maybe I built an office in there or something, then my business could pay me rent. Again, it really doesn't do much because at that point I'm renting it every single month. I'm more than 14 days. So I'm just gonna take the income from my S corporation and put it onto my personal, but it's just gonna be the same amount. Uh, the way we would do it um, is we would use it as like we would do a home office deduction for that. I'm assuming that's what that's related to, because then that way you could just add that square footage space to your home office calculation and run it as a reimbursement, get the expense on the business, but not pick it up personally.
Okay, all right. On the topic of hiring your kids, are you saying that you can deduct up to 13,000 per child per year?
Yeah, if you can substantiate the work, that's right.
Okay, amazing. I wish I had kids. Ugh.
Yeah, go have 10 kids or something, so you get $130,000. Get them to
That's
work.
right. That's right. Okay, and this Anne is saying, what is the age cutoff where you get the tax benefits for your kiddos? It's 18, yeah? Or
The
is
biggest tax benefit is 18. Most college students and above still are probably in a lower tax bracket than you are. So there's still tax benefit to paying them alongside them getting to work in the business with you. We just have to pay Social Security and Medicare taxes. So it's an additional 15.3% of whatever you pay them is going to start hopping on there after the age of 18.
Mhm.
But the income shifting can still be, beneficial. It's significantly beneficial.
Okay. All right. Great. Heather is saying, is there any benefit to paying a spouse who already makes six figures?
No, again, if you're getting a deduction on the business, but when we go to most people's business income flows through to their personal tax return. So you're just saying, hey, let's just make a little bit less of the business income flow through, but we're actually putting it onto the spouse's W-2. So it's all popping over onto the personal tax return, same as before. The only difference is you're just paying even more in FICA taxes.
Okay. Okay. And then Teresa is asking, can you only do this with your own kids, or can you do this with nephews and nieces as well?
Yeah, we've had other people that are like, hey, I just want to get the benefit from the income tax deduction. If you start hiring non-children, then you're going to start paying those FICA taxes. So you lose that benefit, but again, there's still the income tax benefit of shifting it to a lower tax bracket.
Okay. All right, good. And then this one's just a fun one I'm going to throw in before we move to your contact info. JD is saying, and this is having to do with the awards for employees. Are there any items that don't qualify? For example, can I buy my employee a kitchen sink?
Yeah. Yeah, we haven't found any specific information that you can't.
Amazing. I
It
love
just has to be tangible personal property. It can't
it.
be cash or cash equivalents.
Okay. All right. I love it. Well, we are at noon on the nose. Let's get to that last slide. And this right here, if you can scan that QR code, great. Otherwise, take a screen grab. I'm also going to be including this information in the follow-up email that I send out shortly with the recording and the link to the slides. And then, of course, this is how you contact Nate. And for those of you who missed it, Nate very generously said that he offers a free consultation. So, reach out, talk to Nate. You all had some great questions. Nate covered some incredible content today. And Nate, I'm just so pleased you were able to join. This was so informative.
Yeah.
I'm now getting all kinds of ideas for myself, even though
I love it.
I don't qualify for any of it, but I
Let's
love
talk, Terry. We can do it.
I'm going to call you, Nate. I am. Thank you, everyone, for joining us. Nate, you're awesome, and hope to see everybody next time.
Thanks, guys.
All right. Bye now.